Good morning, ladies and gentlemen. I, Dr. Pradiptarathi Panda, from NISM, welcome you all to the third panel discussion of our conference on the mutual funds, the path to 1 trillion US dollar industry in India. So we all are aware that Indian mutual fund industry is attracting the flow of new funds unabatedly over the last few years. The Indian mutual fund industry has grown up in 5 phases. In phase 1, that was from 1963 to 86, there was only one player, that was UTI. Phase 2 was from 1987 to 1992, where PSU banks were allowed. And during phase 3, 1993 to 2002, private and foreign players were allowed. And we have crossed our AUM to more than 10 trillion in terms of rupees during phase 4, that was from 2003 to 2014. And we are currently in phase 5. And we are currently in phase 5 and we have crossed 40 trillion rupees. Our AUM has crossed 40 trillion rupees. And our target is to reach 1 trillion US dollar. That is, in terms of rupee, it is 82.5 trillion. So we all are here to listen from our esteemed panel members. We have 3 panel members: Sandeep, Tandon, MD and CEO from Quant Capital. I request you, sir, to take your chair. Then Stephen Dover, who has joined online with us. He is Chief Market Strategist and Head of Franklin Templeton Institute. And Jain, co-founder and CEO Grow Capital, Grow.in. And the panel will be moderated by A. Balasubramanian, who is Chairman of Aditya Birla Sun Life Asset Management Company. So now I am handing over to you, sir, to moderate. Bala, sir.
Good morning to everyone. So I'm not the chairman of Aditya Birla Sun Life AMC. I'm the MD and CEO of the Aditya Birla Sun Life AMC and chairman of AMFI. Just I thought I'll correct it. First of all, good morning to everyone and welcome to all of you as well as the panel members. Stephen, again welcome to India through a virtual meet. So I can see here. As I think as the ball was set rolling, the Indian mutual fund industry have come a long way. The history of Indian mutual fund goes back to 1964, and the UTA was formed. And since then, major revolution that has happened in the Indian mutual fund industry. Unfortunately, I myself have been part of the industry for almost 32 years. And every time, we keep discovering the mutual fund industry, how it can go to the next level. And despite one of the old industry, and we still have only 9% of the bank deposits is with mutual fund, and which essentially means still a long way to go. And of course, we take pride of now becoming one of the largest industry in the financial market, about 40 lakh crores size that we manage, and close to about 13.5 crores folios have been added, close to about 3.5 crores unique customers that we have. And since the time, the Indian mutual fund industry and the lines of what US has done, promoting 401k as a plan, which I'm told started off in the 1984. I'm sure Stephen can share some views on that when I ask you that question. But India started the mutual fund say, hey, mutual fund investing is the right thing to do. We started off in the year 2016. And since then, the industry has made SIP is the way of investing in mutual fund. I think it's like how Indian households look at recurring deposit as one. And most of the Indian investors have now started investing SIP route, which is systematic investment plan. That number, of course, keeps growing every month. The other big achievement so far that has happened, which is about equity assets under management, become one of the largest, about 20 lakh crore size. In fact, where the Indian capital market used to be extremely dependent on foreign folios in India, since Franklin is one of the oldest mutual fund in the country, most respected in the world. And we all used to depend on foreign portfolio investors in India, whereas Indian mutual fund industry have become so large, the dependence of foreign investors have got reduced, and Indian mutual funds have become one of the large counterforce thanks to the 20 lakh crore size. In fact, as it stands today, 9% of the market cap is owned by Indian mutual fund industry. 9% of the market cap is owned by the Indian mutual fund industry. Having said this, as it always happens in every industry, we still have lots of ground to cover, and we still have huge scope for increasing the penetration in the country in terms of reaching out to the untapped market that exists. As is known, per capita income is rising, whether it is leading to increase in wallet share of the customers is still huge scope is there. In this context, the question remains, 1 lakh crore is 1 trillion size of the Indian mutual fund industry. So we all have been projecting that can come faster, as it always happens in every industry. The initial stage takes a lot of time, and as industry gets matured over a period of time, the next round of growth always become faster than the past. We have seen in the telecom industries, even the mutual fund industry in the last 10 year growth has been much faster than the previous 10 year. But I'm also assuming the coming period will also be a similar trend that could see. I'm sure panel members will throw some light on that. So as the introduction is given, I'm happy to interact with Harsh Jain, founder and promoter of Grow, and they have actually brought in the revolution in the capital market, being one of the largest tech player. They are also the second largest distribution also they have in terms of contribution from SIP next to Zero. So that's the power which I've been interacting with Harsh Jain since the time they founded this company about 4 or 5 years back. So happy to have you on the panel discussion, Harsh. And Sandeep Tandon, again, he brings in rich association with the mutual fund industry. We both of our colleagues in the year 1990, 92. And since then, I think Sandeep Tandon has created a space for himself, especially in changing the way money is being managed from a traditional way of managing to the Quant-based kind of managing. And again, he'll be able to add more insight to the discussion. Of course, I'm joined by Stephen Dover, Chief Marketing Strategy, Franklin Templeton. I always say it's more than 100-year-old company, gone through cycles, being part of various countries in the world, including US and Europe and including India. They were the first one to come into India, setting up their own 100% AMC way back in 94. Again, Stephen, happy to have you part of the discussion today. So I have
broken. Good to be here.
Yeah, thank you. So I have broken the discussions into 4 parts. One, the roadmap for the industry for the next 25 years. So I would like to make each of the panel speakers to give their insight. Then second is about technology-led, how technology and digital can play a role in the whole growth momentum that we can see. And third, what's the kind of product innovation? At the end of the mutual fund there is an element of product pull and push, and new way of managing money also would be the new way of doing things. And then final 10 minutes will allocate the risk. While of course market is becoming larger, and as SEBI has been harping that governance, risk management practices have to also become more and more robust. As the industry becoming larger, managing risk will also equally be important in a prudent manner, understanding the fiduciary responsibility that mutual funds carry while meeting the expectation of investors on one side by taking risk. While taking risk, you should also manage the risk in a manner that best practices are also maintained. So therefore, I've broken into 4 parts. And in the first 10 minutes, we'll have each of the panel speakers giving their overview on next 25 years, how do we see. I'll start with Stephen. Since you have seen US mutual fund industry and you also been closely tracking your India progress, if you can just throw some light on your view on Indian mutual fund industry. I'll come to the second session on US industries from learning point of view. But from a India point of view, how do you see Then I'll come to other panel speakers.
Well, first of all, thank you very much for having me. It's really an honor to be asked to speak. Of course, Franklin Templeton has been involved as an investment management firm, primarily in mutual funds since 1947, and almost 30 years in India, being the first foreign manager within India. I personally first went to India in 2002 and was responsible for the equity side of the investment business in India, and have been to India many, many times. So I can't really see the audience, but it's hello to old friends and new friends. So Franklin Templeton as a whole and myself are very enthusiastic and have a very long-term commitment to the growth of investing within India. I should also mention, I think probably you know that Franklin Templeton was one of the first investors as a foreign investor investing in Indian companies. So not only invests locally, but is a big promoter of India from outside of India, encouraging foreign investments into India. So I thought, just to answer your question, looking at some things that are different in the Indian market, which certainly has developed greatly over the 20 years since I've been there, but probably some of the differences with the Indian market and maybe some insights on where that your market might be going forward is that India is still very much a retail market where the bulk of sales still happen on a commission-based distributors rather than fee-based advisors. And that certainly would have been true when I first went to India and the United States as well 20 years ago. But the United States has dramatically changed to where now most of the mutual funds are sold through fee-based advisors. And so I think that's probably one big trend that is likely to happen within India. So SEBI would consider development of regulations in support of that. And really there's two ways that can go. There are some markets that have encouraged the market to move more towards fee-based advisors, such as the UK and the Netherlands, whereas in the United States, it's been more the markets themselves and the ultimate consumers that have pushed more towards wanting fee-based advisors. But the big point is that's a trend, and I think that will likely happen in India as well. And so that changes how firms interact with the client and is much more based on advice than just products itself. And then I just mention a few things that I think are likely to happen in India as you develop. I think, first of all, likely you'll have lower expenses ratios, which I think ultimately is in the benefit of the client, of course. So we as managers, of course, want to be fairly compensated. But the more things we can do using technology and more efficiency to drive down fees and make the returns for the ultimate customers better, the more that we should do that. Secondly, of course, the other big wave is passive funds. I think we'll probably talk about that a little bit later, but that has been growing very rapidly in the United States. I think that one of the points I'd like to make about ETFs is that they are not inherently passive, that ETFs are actually a delivery vehicle and could be either active or passive. Some of that ability to be active will be based on the regulatory environment, which has been difficult in the United States. This is one thing I don't know about India, but one of the differences between mutual funds and ETFs in the United States is ETFs have much greater tax advantage, and so tend to be used outside of retirement plans, whereas mutual funds are used more commonly now within retirement plans. Another thing will be transparency, that certainly complete transparency of fees and expenses. But one of the reasons that active managers were hesitant to be in ETFs or to be in some other products is because of the disclosure of the portfolios and the fear that that would make them less competitive. And I think that's been a big change in less fear around that. What we've found is that investors are incredibly hungry for investor education, and that we need to do a better job of emphasizing investor education and making investors aware of the difference, to put it very bluntly, between investing and gambling. We've seen in some other markets where the market really hasn't been very well developed, investors have not been very well educated, and they don't realize that difference, that really investing is about building wealth over a long period of time. And finally, of course, there have to be both new products, which I'm sure we'll talk about in more detail, and new delivery vehicles. So we keep saying mutual funds, but at least in the United States, mutual funds market has been shrinking, at least for the last 10 years. What's been growing is ETFs, separately managed accounts, some called SMAs, and where we think there's going to be a lot of growth in the future, which we can talk about, are personalized indexes. So really a movement towards using technology to personalize the investment for the needs of the investors. So I'll stop there, but that's sort of a framework, I think, of where the industry may be going.
Sure. Thanks, Stephen. I think you made some interesting comment. One is a fee-based advisory model, and talked about investing versus gambling. And interestingly, you also kept ETF outside the mutual fund, whereas in India, we count as a part of the mutual fund. So let me come back to you on some of these questions and what is the logic behind those segregations and so on and so forth. Can I ask Harsh to give your overview? If you can also cover in that millennials, since you also deal with digital platform, how millennials also should look at mutual fund, or they will drive the next round of growth, in addition to what thought process you have.
Sure. Thank you so much, Bala sir, and I think it's a great forum. I was really happy to see the campus while coming in. This is the first time I came, so happy to be here and share my thoughts. I have been an investor in mutual funds for last maybe 15-20 years, but in the industry I'm relatively new. Like last 5-6 years is where I've seen the industry from inside, and more than industry, I think I've seen the consumers, users more, because till date we are a tech platform than really a finance company, because we enable people to be able to choose the right products and invest in them. So one thing that I would say is happening, and that will continue to happen, is the awareness, the level of awareness which has gone significantly up in the younger generation of people, like from 18 to 35. These set of people, if you look at any trend, whether you look at the YouTube content consumption of finance channels or Instagram, or even the conversations that are happening, they've gone significantly up. Now 70% of the volume, 70% of the users, at least in a month, would have consumed some finance content. So that level of awareness has come in the new generation of people. When we had started 2016-17, we got to know that the average age of investor is 40 years. Now we see the average age, at least on our platforms like ours, is 26-27, but then the overall industry average is going down significantly. And fortunately for us as a country, we have large pool of people in a younger segment, right? And this is not just by population, even by the wealth creation. There's a lot more money coming in the hands of younger people now with all the opportunities out there. So the whole wealth, which is now getting accumulated with the right set of people getting aware about mutual fund, I think this is a trend which we'll see continue, enabling more and more people getting into the industry. And one more data point, I think you all know that the penetration till date also is very low. While the last 3-4 years we saw very good penetration, still I think around 36 million people are actively investing in mutual funds. While if you look at the number of people who are doing fixed deposit or lying the money in the bank, there will be like 200 to 300 million people, right? So there is a path that our industry will cover in the next probably 10, 15, 20 years, where we will be able to see everyone has a very well diversified portfolio. They'll have mutual funds, they'll have some stock, they'll still have fixed deposits if that makes sense for their risk appetite. But the diversification will happen because a lot more people will ask, they will understand, they will participate, they will take risk, or they will diversify, and overall, everyone will be able to participate over time.
Yeah, thanks, Harsh. I think the interesting comment is on two. One is 26 to 28 is the average age of these investors. Essentially means they can continue to grow. Therefore, $1 trillion is easy to achieve. Second, of course, I think another number you used, about 200 to 300 million people have got bank balances and FDs, and they're not invested in mutual funds. So that itself reflects the $1 trillion how it could come. Sandeep, again, you have been part of the industry, but now you are an entrepreneur in the Indian mutual fund industry, setting up as a owner of mutual fund industry. Now you set it up. Now you're looking at, I'm sure without being bullish on the industry, you would not have come to the industry. So what's your sense?
Yeah, thanks, Bala. So I will slightly deviate and talk about, let's compare mutual fund industry like a FMCG. Okay. How your consumer durable has grown or staple has grown, they become part of your life. Okay. Whether it's you talk about soap or tea or anything, there's you consume. Similarly, saving products are also becoming part of life. When we started our career, it was very early stages. It like very elite people used to be participate in the market, limited people. I'm talking about way back in 92, 93 when I joined GIC Mutual Fund. Early stages, people are very skeptical. I come from North and equities are considered bad. Okay, speculation, gambling, that was the terminology you used. Since I came from a banking background, my dad was a banker, so it's still acceptable. The society was very different. Today, look at that consumption theme is picking up. India is one of the young population, the consumption is rising. And the way you look at US markets, assuming that you earn 1 lakh rupee, people in US spend 70,000 rupees on your daily household. 20% of that amount goes to the mutual fund and 10% to the insurance. That's the way broader setup is in US. In India, the insurance percentage is still on the lower side. It's going to rise. So we look at this business as like a FMCG space. Distribution perspective, the way FMCG products are available through masses or various channels. Similarly, courtesy ARN, MFDs, distributors, our mutual fund products are available to even B30, smaller towns, village. An amount of changes which is happening, even technology has played a very big role, awareness part if you talk about. I think this is the way I look at this space, it is your need, it is your something you have to consume. So that's the way people have started looking at a mutual fund industry. And instead of getting into a debate of per capita, what we have achieved may not be the right standard. But if you look at from the banking space, what is the FD levels? Okay, very sizable. The mutual fund industry is not even 0.5% of that number. So that opportunity itself is very large. And I'm comparing with banking because the mutual fund industry offers better innovative products. Okay, the innovation in banking sector is very, very limited, where courtesy SEBI allows us to innovate a lot on new themes. We talk about Stephen, talk about ETF. Today we have seen only the passive ETF in India. What about active ETF? A combination of active and passive ETFs. Okay. If you look at the leverage products or the derivative route, not from the leverage point of view, but unique opportunities are available from the hedging perspective, protection perspective. Okay. Those products have not been even used in this point in time. Then we talk about even how multi-asset can be combined on various combinations. Okay, very early stages we have seen bullion, now silver has been allowed, some commodities will come. Just imagine the opportunities which is here building, and I'm talking about a multi-asset concept or multi-manager as a concept which is evolving globally. Okay, so I think we are in a very, very early stages, great opportunity. The way industry is changing, and I think COVID has done many good things to the industry. This digital aspect, people who are not familiar with the technology, we look at our maid servant, our parents, who are not used to things, they're so equipped now. And I think that is, if you ask me some event from, I should not say, but COVID has done a lot of damage to the world. But for the mutual fund industry and particularly in India, it has done a lot of good things. Okay, the way technology is changing and supporting. So we remain very constructive. This is a part, so it's a consumption theme. That's the way we look at mutual fund and insurance business, and mutual fund more, because India, the insurance is also picking up, but the saving aspect as a consumption theme is something which we think that's the way I look at this industry.
Thanks, Sandeep. I think you brought in a completely new dimension, which is linking to the consumption to the investing. And then Ambari also mentioned about the US, 20% goes to mutual fund, 10% goes to insurance. I think India would be the other way around. And large portion of the money goes to insurance and less goes to the mutual fund. Again, that itself confirms once again kind of $1 trillion mutual fund size is not a far off distance. Again, it gets reconfirmed. And then linking to the consumer durables, I think it has to come way of behaving, and also talked about ETF can also be passive and active and so on and so forth. We'll of course discuss more on details in the subsequent discussion. Moving to the next on technology. I think Sandeep mentioned about COVID definitely has brought in revolution in the technology space as a country as a whole. All of us know about it. The same time, there is one data point I think we all take pride. The number of demat account opened during that period was highest. Almost about 13.5 crores demat account got opened. We would have otherwise taken 25 years to open demat account. Just one lockdown has made 13.5 crores or 14 crores demat account got opened. The large, of course, contributor LIC itself has made all their policyholders to open demat account. At the same time, the number of people participating in the equity market also went up quite significantly. So linking that and also how the mutual fund technology space as it's evolved and how it can get evolved as we move forward. I think Harsh, if we can just give some insight on that, then I'll come to Stephen to take his input as to how US mutual fund industry have adapted the technology change in offering best solution to the customers, and both in terms of onboarding as well as building the customer expansion of the market. I'll come to Stephen next.
Sure. Yeah. So there are two aspects of the technology innovation, and I think one is on the product side and another is on the distribution and experience side. So I'll leave the product side to Stephen and Sandeep. They are experts of that. I can probably talk about the customer side technology. See, traditionally mutual funds were sold. They were not bought. Like nobody gets up in the morning and say, today I want to buy a mutual fund, right? It used to get sold. And why? Because there was an education, information, there was a convincing, there was some push selling and everything needed to be done. And the reason we could not expand as much as we would wish to was because it's expensive to go to the nook and corner and to be able to serve to everyone, because the model was like that. But now in the last 5-7 years, with the technology, with mobile apps, with websites, it's so economical to go to even a person who is in a tier 4 city who is earning probably 20,000-30,000 a month and is okay to invest 500 rupees also a month, right? So the access itself was possible till date because of the technology, and I'm sure there's a lot more scope if it can be further gone down to even the next segment of people and taken to probably 5x, 10x in terms of the number of users from there. The second was the ease of transacting. I remember when I opened my first Demat account back in college, 2004-05, it took me 7 days because I signed a lot of documents and then I had to wait, I had to follow up, and then the account was open. Now I could see that I can do something. But now that happens in minutes. And thanks to, of course, a lot of regulations have also enabled us. A lot of technology has come in where real time we can do KYC, real time we can do account opening, we can do face recognition, we can do all the necessary checks and balances, where the ease of opening account, ease of transacting, the money movement with UPI, with all the net banking has become so easy. You don't need to sign check, you don't need to give it to someone, and then you don't need to wait for 2 days for the money to come in the bank account or the mutual fund account. So with both the access and the ease, and the third point is the transparency. I feel there's a lot of role that the technology can play to build more transparency by providing the right information at the right place, right content for people to understand, learn. So all that information, all that charges, I think we spoke about, the myths that were existing, and they still exist in certain pockets around mutual funds, because some people will say, it's the same as equity. I think a lot of people, even mutual fund, they feel like it's a speculative product, it's a risky, I will put money, where will it go, what will happen. So I think with the transparency, once we build that trust, that can also get solved. And all these three things can happen 10x faster if we are able to leverage the technology in the right way.
Stephen, would you like to cover on the technology space how US MF industries have adapted to the technology change, since you have been quite advanced from the technology space concern, and how mutual fund industry in US got the benefits, so that we can take some learning from them in our $1 trillion mutual fund industry growth?
Yes, so I think that technology is going to enable India to meet massive growth that you allude to. So I think that is, I said already that I think that probably a big change in India will be moving from a commission-based to a more advisory fee-based. And technology is, I think, what's really changed the American market, and is one of the reasons the American market has changed more to advisory. A subset of that is that what I would call a movement more towards solutions rather than towards trying to sell individual products. So helping the advisor be able to give good advice to the client in terms of their individualized goals and in terms of their entire portfolio, rather than just trying to sell whatever the hot product is. So changing commissions, changing solutions. So how's technology going to enable that? I think that probably one of the less expensive ways for a large number of the Indian market will probably be through robo-advisors. And this is an area where SEBI will need to be on top of the advice. But if it's done appropriately, I think this could be a very good thing, particularly for smaller investors, to help them reach their objectives and to have a more diversified portfolio. I myself have always been on the investment side, managing portfolio managers, not operations or marketing. So I'm excited about technology helping, especially big data and artificial intelligence, to try to better analyze market trends and to try to really help make investments more personalized, again, to the client. Blockchain technology, which I think India, again, could be ahead of other countries, including the United States, could automate a lot of processes, including trade settlement and clearing, and to provide tamper-worth and more trustworthy transaction records. Cloud computing, obviously, to help store and manage data. And so then the final thing I would say that is commissions changing, solutions, and then personalization, that technology will allow advice to be very personalized towards the individual objective of investors. All of that can help the industry grow, can be very good for investors, but also needs to be handled in a very transparent and honest way.
Sure. I think thanks, Stephen. I think interesting you made, I think, product to a solution and including creation and blockchain kind of model for transactions easiness and so on and so forth. I think it's mentioned about, I thought I'll ask this question right away to you. I think you often mention about in your discussions advisory versus the distribution commission based model, and especially in the advisors model in US is pretty large, and they are able to, of course, charge their customers for the advice that they provide. Whereas in India, we do have advisory model, but we don't have the mechanism by which through the regulatory framework we can charge the customers in India. Could you throw some light what made the advisor model to become more successful in US, and what regulatory support or regulatory environment would have given them a support because of which they have become larger?
So I think that from a regulatory point of basis, as I mentioned, some countries like the United Kingdom, they push the advisory model. So there's a little bit of philosophy here that the sales model, the commission model, could potentially encourage advisors to sell what they get the most commission on. And so there's been a change in thinking that it might be better for clients that the advisor is neutral on which vehicle they advise the client to buy, and that they charge for the whole portfolio. That's the advisor model. And so I think particularly during the Obama administration, there was a big push to encourage lower fees. That was particularly through ETFs, and to push the advisor model. I would say that the growth of passive investing and the growth of the advisor model are linked with each other, because obviously advisors would generally not sell ETFs because they weren't paid for them. But if they're being paid for the whole portfolio, then they're somewhat indifferent between active funds and passive funds. And again, looking more at the total solution. That said, I don't think that, I mean, there's pluses and minuses of both. I think that that in some cases the advisory model has had more turnover. So I'm not making the case for one or the other. I'm more observing what the very likely trend would be in India, and that there are different models in Europe. We moved to that advisory model through regulation. In the United States, while it was encouraged by the government, it wasn't really regulation that pushed it. But there is supportive regulation to allow it.
Sure. Thanks, Stephen, for this insight. Coming to Sandeep, I think you are using technology. I think one other thing which Stephen mentioned about artificial intelligence can also provide greater input while managing money. And you are the one who has used technology, data analytics in building your own portfolio. If you can just throw some light on that, as well as on anything that industry should do, given the fact that where we are today, as Guru mentioned, as Harjan mentioned, as Stephen mentioned, what incremental can be done on the technology side?
Thanks, Bala. So I think Stephen talked about how robo advisory is coming in. That's a role to play. In fact, when we started our career 30 years back, there was no concept of ML or AI. Okay, so we have tried to build in last many years the concept of predictive analytics. Okay, which is again analytic by using technology and analyzing data. Okay, so the way we are trying to build Quant mutual fund is all about data analytics. Okay, because I'm going to link with the risk. Okay, because the market is driven by narratives. Okay, and narrative can be manipulated, narrative can be built. Okay, because it's all about narrative which gets built. And sometimes narrative is very different from the actual data. Okay, I'll give you small examples. Okay, let's say today you read the newspaper, you say, I just read it's today's newspaper. Okay, but for you, it's today's development. For me, it's maybe 15 days old news. What comes in the media, it's all about people like us who are early in subscribing a lot of data, early in spotting trend. They only talk about it. Okay. So what the narrative gets built on newspaper article is very different. So when we talk about predictive analytic versus postmortem analysis, okay, when the whole industry does postmortem analysis, I was also party to it, okay, for many years, okay, where event is unfolded, we're going to sit down and try to analyze what has happened, how it will affect us, okay, and instead of doing that, we try to build through predictive analytics model, trying to using technology in a big way, because manually it is not possible. So we subscribe a lot of data. So we run complex multivariance model, okay, where dependent and independent variables are captured. The whole idea is how we can bring down the dependence of price, which create biases in our mind. Okay, anything when we talk about valuation analytics, okay, where we all fail is all about because it's dependent on one dependent variable called price. And that's where our human biases come into picture. Okay, and one of the reason when over a period of time with multiple mistake, we try to create a predictive analytics model, and then this is basically a risk mitigation technique we are using through technology. Okay, without technology, it is impossible to visualize. Okay, so if you really look at maybe as a mutual fund, could be only mutual fund who has a lot of programming ability in our company. Okay, we have analytics team working for us. And that gives us a meaningful edge, okay? And you are able to differentiate between what I call data and narrative. So when you start building everything on data, the outcome is very different. So that's the way the edge of technology comes into picture. And name you what about AI, machine learning, we call it predictive. And because in our term, there's no concept like this. Now with the help of, we are also user of these technology, okay? And I think what Stephen talked about robo analytics, that is the way forward in the advisory side of the business. Even the mutual fund side, some of us will be launching something similar in this space.
Thanks, Sandeep. I think interesting. There's so much can be done using technology, and in a matter of 10 minutes discussion, brought into light and had a discussion about sold and bought. Very powerful. So two words, but very powerful. How technology can enable build a trust, speculative versus non-speculative, and mutual fund is not a speculative, but it is investment. How do you build that trust, which Harish mentioned about? Both Stephen and Sandeep mentioned about. Clearly, technology means normally we think about onboarding of customers, ease of doing transaction, KYC, and so on and so forth. And I think going beyond that, how technology can enable even the money management side, so to speak, bringing in a robot advisory kind of model. I think all of them actually evolving situations and evolving trend. And definitely the technology can actually play a huge role if the MF industry also is able to adapt this kind of model. I think I'm sure would have greater impact on our 1 lakh crore, $1 trillion mutual fund size. Coming next to the related on product and innovations, I think as we all know, I think Indian mutual fund industry plethora of a product, and even I was part of one of the committee in SEBI, clearly defining what do you mean by large cap, what do you mean by mid cap, what do you mean by small cap, what do you mean by thematic, and what do you mean by duration. So we all in the last so many number of years, the entire product pipeline got streamlined. So sometimes we do think, is it killing the innovation? Standardizing definitely is good. Is standardizing actually killing the innovation? And that's the point of debate. Second, Stephen mentioned and very clearly that moving away from product to the solution. And so this is something will always remain core part of the mutual fund. Given the fact the product is not there, then you cannot grow the size. So I would like to start from Harsh. How do you see, because you are using technology, I think you mentioned about product selling versus buying. And if you can just throw some light, what product innovation could come, which could be the new order on the mutual fund industry as we move forward.
So, as an investor, when I look at the options available, I still think there are too many options, because I as an investor want to have one option, two options, three options, or three funds where I can park my money, invest my money, and kind of diversify and be happy about it. But when you look at the industry, right? So there is always a concept of Pareto. There will be 80% people who will be investing in 20% of the products, but then those other 80% of the products are required so that you can cater to a long tail of users, and eventually it could be a starting point for those investors, but eventually their money will also get concentrated towards a very limited product. So while the range of products or the innovations can bring in more variety, it can connect with the potential investors in a different way based on what their understanding is, what their preference about the industry is, or what their preference about passive versus active versus actively managed passive and the combination is. Eventually it'll needs to be streamlined. So while I really appreciate the move that now it's more organized, that the fund name are structured, and it's not really killed the innovation, but it's brought more trust for the investors. Now they understand what they are getting into. So there is less scope of differentiating on the name or on the outside. It's more left to the fund houses to innovate on the inside, which is what I think we talked about, and probably Stephen and Sandeep will talk more about the product, whether it's a more range of ETFs or it's more range of passive funds, or it's more sectoral funds that can help. I think there's a lot more potential in the way the funds are built and presented in terms of the experience of people investing. Still, they take 2 days to put the money, it takes 5 days to redeem the money. So there's a lot of product innovation from a operational point of view also, which is possible, which can improve the experience and build further convenience and trust in the system.
Yeah. Thanks, Harish. I think moving away from product, even the value-added product services related innovation could also come. I think that's the that's one way forward. Just coming to Stephen, I think you mentioned about ETF, passive advisory, and I have two questions to you. One, the money managers, the reason, of course, the ETF and passive are picked up, there is underperformance for active managers. Is it bad, or is it something they are doing wrong, or is it something they are not capable? At the same time, ETF takes away the underperformance risk, therefore you link to the market. Does it mean that ETF is more safer than active manager? And how do you see this thing is moving? There is also growing feeling, having grown to 50% US mutual fund industry is a representative of passive. There is a growing feeling that there will be a shift towards active managers, given the fact that customized ETF have also done very badly in US thanks to the FANG stocks and so on and so forth. If you could just throw some light on this in terms of journey, how do you see, and how India can also shape up in this direction?
So I think that when mutual funds first came out, prior to there being passive strategies of any size, that mutual funds were actually selling both beta as well as alpha at a fairly high price. So they were selling diversity, and it was probably one of the only ways investors could get it. So what ETFs and passive strategies have done is make beta almost free. And so I think that's good for the ultimate consumer, for the individual, and probably someplace where the industry should go. So to the extent you just want beta in your ultimate portfolio, it's probably best to get that through a passive strategy. So that means that active strategies have to really change. They actually have to add alpha, and they probably have to add alpha with the beta separated out. And I think that that's a really difficult proposition. And I don't know that active managers have totally figured out how best to do that. But certainly in the United States, we see products that were very broad, beta sort of products, whether they're products that are indexed to the S&P 500, which is the most popular index in the United States, or global indexes. Those funds have not done very well. They haven't tended to beat the benchmarks very much. And I think part of that is just because most of the return from those funds are actually beta. I would tie that back to my premise, and one of the things that's different in India that you've alluded to, and I'm not an expert on this, but I know that to some extent the number of products in India that mutual funds can offer are limited, which is a regulation we don't tend to have, or that I'm not aware of outside of India. And I think at some level that makes sense because you don't want the proliferation of product. But in some sense, I'm arguing the opposite as well, in the sense that I think the future for India and the future of the industry is going to be much more towards solutions. And that's where an active manager should be able to add more value, that it's focusing on helping a client meet a specific solution, whether that's saving for college, saving retirement, or saving for a swimming pool, whatever the objective is. And that takes active advice to understand what to do, including the advice of where or how to allocate your beta. I think that's the first step. And then I think the next step is really to move that towards personalization, which can only happen on a massive scale with a lot of technology. So I think that's the challenge for regulation. On the one hand, not to have a proliferation of product, but on the other hand, to have products that are best suited for the client, which may mean, ultimately very personalized products, which by definition is a lot of different product.
Yeah. Okay. Just one related question on this, Stephen. I think if one looks at during the pandemic time, FANG stocks did exceedingly well, and the same FANG stocks fell very sharply, ranging from 30% to 60%. And I also given to understand the active managers did not own FANG stocks, therefore they were underperforming, and then the same managers did not own FANG stocks when the market fell, therefore they started performing better. How do you relate these two things from a risk point of view?
I'm not exactly sure that I give you a very good answer on that. I'm sorry, but because I'm not exactly sure why the managers did that. So let me give a tangential answer to that, and that is that India is still a fairly concentrated market, and so it seems to me that active managers, can probably add more value away from that, the big top 10 equities or so within India. And that's probably where managers could add more value. Also, perhaps diversifying outside of India, but always having the majority of assets in India. What I'm saying with that is not necessarily buying foreign funds, but buying funds that somehow have Indian stocks as well as foreign stocks. I'd argue the same for fixed income. To help the clients diversify their risk.
Sure. Thanks, Stephen. Of course, I specifically asked this question. The reward always comes for performance. The reward is not generally given for smart skipping. So that's why I asked this question. Of course, I still understand your point that ETF as an asset class is growing. Therefore, active managers also have to change their model. There's a related question on Sandeep. Sandeep model is, of course...
Can I just add, that's going to be easier to do in India in some ways than it has been in the United States.
Sure.
The problem the mutual fund industry has in the United States is so many legacy funds. And while, yes, there are a lot of millennials that are investing in terms of numbers, most of the assets are in retirement accounts or with an older a group of people who, for tax reasons, for a whole bunch of reasons, are stuck in these funds. So I think India has some opportunities for innovation and new products that the United States will take, and Europe will take a long term to make those same changes.
Sure. Thanks, Stephen. I think Sandeep, of course, advocates, I think you use the word beta and alpha. And Sandeep objective is to only look at both the number more closely and use the predictive model. And Sandeep, you can throw some light as to how a product, the existing versus future, how it can get shaped up.
So I'll take it where Stephen was talking about, talking about adding alpha and subtracting beta. Okay. So even when we try to do at Quant Mutual Fund, what we try to say that we are in the business of risk management and returns are byproduct. The day you decide, the problem that comes from the industry when you start focusing purely on returns. Okay, this is my track record, this is the returns I have given, so this is what IR I will commit. Okay. And that's the way problem starts. The moment you start managing money, like how large banks or treasury manages, the whole focus, when I'm just deviating a bit on this and I'll come back to the main thing, is all about how well you preserve your capital first. Okay. Because in this industry, we have seen some amount of myths. Okay. We are long term. Okay. No, investors are long term. Asset classes are long term. Stocks and sectors are not. And this is the one myth which has been built over a period of time when people don't perform and says, no, I'm a long term. Because I'm linking with the risk. Long-term risk is easy to manage, where short-term and near-term risk are difficult to manage. So if we start managing our risk properly, when we're talking about as a portfolio, we have stocks from a longer-term perspective, medium-term perspective. If we start looking the entire thesis from the risk perspective, that I have a longer-term risk, shorter-term risk, medium-term risk, near-term risk, you will resolve majority of the problems. Okay, and this thesis about risk mitigation is something which we are trying to build through data analytics. Okay, let's give you a small example. I have also grown. The whole industry has grown with only the concept of valuation. We call it fundamental analysis. Okay, is backbone of the organization of your investment thesis. But apart from that, the liquidity analytics are equally important. When COVID boom happened, when the market, everybody has given up in March 2020, by September 2020, market has rallied. What answer we gave? Oh, this was liquidity driven rally, tsunami of liquidity. But in our risk management process or investment process, we don't look at the liquidity analytics. Maybe debt side people still look at it. But the equity side, we don't look at. We all know the concept of impact cost, but how many people actually implement the impact cost? We don't even track. Okay. So the thesis about risk appetite, we all talk about risk, and risk is only visible in postmortem analysis. Risk has risen. What about risk appetite? Which is your conviction, confidence level. Okay, I'll give you a very classic example. September 2021, whole world was euphoric. When as a Quant mutual fund, we talked about that something has changed in September 2000. There was a euphoria. Globally, what has changed? Risk appetite, liquidity. I'm just trying to link with risk aspect, the whole thesis of innovation in today's world, how to add alpha and reduce the beta. That is the entire thesis. If we can change a bit our thought process of running around for returns, the whole perspective will change and you have better safety and security.
Interesting, Sandeep. Thing is, again, use the two words, beta and alpha. Reduce the beta and increase the alpha. Reduce the volatility and increase the return. It's easier said than done, but model can make it really work. So that's again interesting thing. Second, you mentioned about risk versus return. I think most of the people, of course, look at the return, but not the risk. And first, if you understand the risk, the return is an outcome of that, which I think very beautifully said, Sandeep. Just two things I just want to discuss. One to Harsh, Jain and Stephen. I think all the discussion generally is around equity market, and so on and so forth. Generally, mutual fund means in India, of course, we think equity. And I presume in US, bond market is also equally big. When it comes to the question of solution, product, the fixed income market in US play a very big role. And even US market has got, what is it called, junk bond is a big market and so on and so forth. So I would like to hear some views from both Harsh, Jain, how it's important fixed income asset class in investors' point of view. And also Stephen, the success of US where the ownership of US investors equally high or good as good as equity in the fixed income space. And if you can throw some light how that market became larger in fixed income as big as an equity. And that could probably, you going first will also give us some learning as to what we should do in India. Yeah, Stephen can go first. Yeah.
Oh, okay. So in the United States, I don't know the exact numbers, but the kind of traditional portfolio, if you will, is a 60-40 portfolio. So it's 40% fixed income. A lot of the thesis around that is the somewhat lack of correlation between fixed income and equities. So the discussion on risk is actually really important. I would just point out that adding alpha to your portfolio has to be risk adjusted. It isn't just absolute return above the portfolio. So fixed income and adding that to your portfolio is probably one of the better ways to have better risk adjusted returns. I think just for the development of the Indian capital markets, it's also important to have a depth within the corporate bond market, including both high-grade corporates, but also, yes, as we call them in the high-yield or sometimes called junk bonds in the U.S. as well. For that market to work, you need good regulation, you need good bankruptcy courts, you need a good system. But a lot of the growth in the United States, particularly through buyouts and venture capital to some degree, has been financed by those high-yield bonds. So it's both important from a capital markets point of view, as well as from an investor point of view. If I may, I think that where the real trend goes in the United States is really beyond that, to add other elements into the portfolios, which we're just starting to see the growth of. That includes real estate, not just what, at least in the United States, are called REITs, which are publicly traded real estate, but also more private real estate, private debt, private equity, venture capital. The kind of new model portfolio is shifting from the 60-40 to something where there's a smaller amount of fixed income, and that amount of risk budget, if you will, is taken up by more private investments. And I suspect that's something that India will follow as well. and that will need a lot of careful regulation because it's, bluntly much more complicated.
Yeah. Thanks, Stephen. Harsh?
Yeah. So we would be surprised in the room if I tell you people treat SIP and mutual fund as different products, right? When we go out on the street, talk to people, are you investing in mutual funds? They'll say, no, I have SIP going on, right? So the knowledge and the information about mutual funds, about this being, equity based is just very recent. And for us to, even if I talk to my friends who are working probably at Flipkart or Google or Apple, they will not know about bonds. They'll not know about fixed income products. They will just know that, there is a stock market and then there are mutual funds that somebody else manages for us, and it's a kind of aggregation and diversification that we'll do. So beyond that, very different. If you talk to maybe a tier 2, tier 3 city, people running their own small shops, they would have never heard or will never understand what bonds are, what fixed income products are. They will understand FD, they will understand current account, saving account, and the interest rate that they get. So over years, I think we've done great job in simplifying the mutual fund as a concept and how people can participate in the equity side of the capital market and invest, diversify. But there's a lot more work to be done from the fixed income side also. Fixed income products, there can be good. I mean, there are a lot of benefits why one should look at that asset class, both from the investor's portfolio point of view and of course from an industry point of view. When we get more liquidity, then there can be more, it just fuels the economy, right, in some way. So both ways there has to be there needs to be a significant effort, how people will start understanding, appreciating, accepting these products when it comes across them.
Yeah. I think interesting comment. I think what Harsh mentioned about SAP versus mutual fund. In fact, I've done a lot of the hard work in making SAP as more powerful than mutual fund from the investor's acceptance point of view. I think what you said is true. In a public forum, if you ask question, how many have invested in mutual fund? No hand will rise, or minimum hands will rise. The moment you reverse the question, no. I have to ask the question. And then you ask the same question on SAP, how many have invested? The entire full hands will rise. That's the beauty of the branding, making mutual fund agnostic to the market. I think what you are saying is essentially fixed income also we need to create a similar kind of category as we have done in the case of making a mutual fund popular through the mutual fund Saihe, and that should get extended to the fixed income as an asset class. I think if you want us to go by product solution based approach, then fixed income should also become equally good. As Stephen mentioned about, I think he mentioned, of course, India doesn't provide the liberty to fund buyout financing, private capital. Those liberties not there as a mutual fund. We all used to enjoy. It's about 5-6 years back, but there is now a history given the fact that we went through our own challenging period about 2 years in Indian fixed income market. But of course, your point is right that we need to, of course, build fixed income as a category to go to the next level of growth. Coming to the last sessions, risk and regulation. I think we discussed enough on risk, therefore I don't want to go too much on risk. I think regulatory framework. So I always believe, fortunately for me, when I started the mutual fund, there was no regulation per se. And in the 1992, of course, we set up in 94, and then regulation got evolved over a period of time. The beauty of Indian mutual fund industry is regulation also got evolved on the basis of the experience that you have gone through at each point of time, right from technology bubble time to the subsequent period, regulation got evolved. And if each one of you can give some insight from an Indian mutual fund point of view, what is the top regulatory changes is, of course, taking care of investors' interest. And the second is what kind of incremental risk measurement metrics that we have to take in order to ensure that next round of journey becomes more fruitful and stronger. So if you can go with Sandeep first, then Harsh, then come to Stephen.
Thanks. So I think in last 10-12 years particularly, I think a lot of changes we have seen on the regulatory firm. But what we want, a very pragmatic approach. Okay, I think industry has grown in a very haphazard manner, and I think in last many years it has been streamlined, and even putting restrictions on types of names of the mutual fund and various categories a good step, so that clarity is there. But what we need is the flexibility, okay, and innovation aspect. If you really look at from the mutual fund how globally it has been evolved, okay, so it's a self-regulatory body type, the way industry has evolved globally, we were looking forward that more and more products will be allowed out here. If you're talking about, let's say, ETF, okay, very simple ETFs are allowed, but complex ETFs are still not allowed, okay, based on the risk profiling of investor, and in industry has evolved a lot. If we offer these unique products which can be designed, I'm not talking about leverage ETF on immediate basis, okay, I'm talking about more innovative products which can be built, step in right direction. If that can be accelerated, okay, I think industry has much more potential, because today it has changed a lot, it has evolved a lot. I think a lot of things has yet to be made, because that's the way risk mitigation aspect will come, okay. Today if you really look at the derivative products has come to India, but I can tell you not even 1% of AUM is protected through that route, okay. Various reasons, we can talk about liquidity aspect, we can talk about awareness aspect, okay, or general resistance. I think those are some of the changes which we have to bring to the industry from a risk perspective, risk appetite perspective. And it's a good part is still evolving. I think that's the way. I think industry also has to come out with unique solutions, some innovative measures, innovative products, okay, including inverse ETF, including ways to hedge the product, even complicated multi-asset products, okay, which is don't exist, and globally it exists. So I think it will reduce the risk. That's the way I will look forward from a risk mitigation point of view.
Yeah. Thanks, Sandeep. Harsh?
So I think we're already doing a lot of work from the regulation side, but I think one saddening fact.
Can I also ask you,
Yeah,
are we
please.
going overdrive on regulatory changes?
So sir, I don't feel
Though
that.
I cannot ask this in front of a regulator,
Yeah.
but still.
No, I think you've been part to a lot of the changes which has come, and I think we've been also fortunate to spend some time directly. And I think the changes are happening for the larger good. I think one area where what is still saddening is when we go out and talk to people, there's a lot of mis-selling happening on the floor. Now, see, all of us, we will also soon have our own fund house, and all of us here in the panel have their own fund house, and we want to, commercially, we want to distribute funds. But then what's changing now is a lot of people that are coming in the industry want more transparency than the opaqueness, which has plagued the industry in the first, few decades, and now it's getting much better. And I think a lot more, say for example, so I was the driver who drove me here. He accidentally started asking about Grow, and then he said, "I've been investing in mutual funds. I have SIPs and everything." And I asked him, "How do you decide where to invest?" And he said, "Okay, I listen to the YouTube, I read, and then I found out, I discussed with my friends, and he talked about 4 funds." Then I asked him, "How do you invest?" Then he said, "Okay, I'm investing from my bank." And I asked him the difference. Do you know it's a regular and direct, the difference? And he said, "No. He just told that it's free. I don't have to pay anything, and I invest in it." So what I'm realizing is that a lot of people are doing the work that was accounted for when there was a whole structure of regular, and then the direct got introduced. And the transparency of these funds, the information, the knowledge, the education part, I think there's a lot more work where not just regulator, I think we all as a industry participant needs to do. And the generation of people coming will appreciate if things are charged upfront, then not being transparent. I think that connects back with the point. So like next 15-20 years, we'll probably see more, less of the distributed or less of the commission structured, more of a direct or an advisory based funds.
Yeah. Thanks, Harsh. I think that's again interesting to hear a driver knows about mutual fund. But I mentioned about mis-selling. Stephen, if we can ask you, one, the regulatory intervention in US being the large industry, if you can just highlight some bit on your own experience, how do you see it? Second, there is always a school of thought that big versus small and small versus big. Big means they have an advantage of scale. Small means they don't have the advantage of scale. And US has got about 350 mutual fund, I presume, and BlackRock have got the largest share of maybe about 20%, and top 10 would be taking away roughly about 60-70%. If you can just bring in some insight on that, would be helpful for us to understand and learn from that from India point of view.
First of all, I'd just like to say that, I have met with and worked with SEBI over this course of this last 20 years. So I have a very high regard for SEBI and the regulatory environment and difficulties that it's had. So I guess my real points on regulation is that you want to make sure that that there's as much transparency and disclosure as possible, and particularly with fees. And I think that's been one of the movements in the United States to make fees clearer. And again, as you do that, that helps the shift from commission to advisory. You want to make sure, if you do have advisory, that the advisor has to disclose all of the fees all of the way through. That's going to be more important as you move towards private investments. I think that where the U.S. is trying to have better regulation, and SEBI could probably do better, would be in looking at how to regulate the solutions model that I've now discussed several times, supporting the advisory model, and that balance between not having product proliferation, but also having personalization of solutions and products for clients. In terms of the scale, actually no firm, including BlackRock, has a big part of the total market, even though it's huge. And so the investment market, the mutual fund market, is more fragmented than most markets within the United States. And I think that's probably positively a positive. That said, obviously there's a lot of concentration. We've done an acquisition over the course of the largest acquisition in the world when we acquired Legg Mason. And so obviously there is concentration. And we think that globally there's probably going to be some big players that particularly work with the global distributors. And then there will always be niche players that do different things.
Sure. I think thanks, Stephen. I think the point that you made about fragmentation pretty high in the US as well. I think that thanks for that input. Coming to these closing points, I think Harsh, we can just mention about, often we discuss about consolidation of mutual fund industry. I think you mentioned about, Stephen mentioned about that you have been buying out assets to be a large scale player. At the same time, market remains fragmented. Now we are of course moving towards more and more players joining this mutual fund industry. Is there any more room for more players, or consolidation will be the way of industry?
So I believe there's a lot of potential because, going back to the penetration level in India today, so last 20-25 years, we are able to get to, say, 3 crore of people, participate and then invest. And there's still around 30-40 crores who have or who will potentially have in the next 20-25 years. So there's definitely potential for more players to come in with more innovative solution, with more disruption. I think that also connects back with the environment where there's a disruption possible. And just want to connect with one example. So the internet, somebody took it on them, and then they disrupted the internet. And then payments, UPI came in and then disrupted. So I think that's that level of movement in the mutual fund industry we are seeing in the last 3-4 years, and another 5-10 years with a lot of regulatory changes. I think ease of small transactions and reducing prices. So there's a lot more scope for more people to come in and create some disruption, which will give us that moment that UPI and internet Geo had in the mutual fund industry also.
Yeah. Thanks, Harsh. You want to add anything more, Sandeep? That's okay. Yeah. I think good discussion that we had, almost about 1 hour, 10 minutes. I will not do justice for this panel discussion if you don't take at least 2 questions from the audience. Yeah. For want of time, I'm making only 2. Yeah. There's one in the first, and second, the man who raises his hand for SAP investing. Yeah. You can direct to any panel member if you want.
Sir, I just want to, all the panel member, mostly Indian panelists. Sir, if you see the mutual fund industry, as you mentioned, there's a big player and a small player. Okay. And we have seen that there is a huge concentration risk. Not in terms of AMC, in terms of scheme level also. So if you scheme in a particular category, there is an AUM, huge range, is a bigger player, top rank scheme and the bottom rank scheme. So do you think what is the role of the portfolio manager who is managing the scheme? And even we have seen, so few scheme over the time of the period, it has been decreasing their AUM. So since you are launching new fund, so what is the role of the portfolio manager in this case?
Harsh, you want to take this question? Given the fact that that you also
So
ran.
I'm not, so I'll not be able to tell you a lot from our experience. I mean, I can tell you more for how we are thinking in future, but I think, so role of the portfolio manager is definitely to, reduce the risk and the returns will follow. And at a significant size, so far we have not seen enough liquidity for certain kind of products. So for example, small cap becoming too big, or there used to be a micro cap some time back, becoming too big becomes a risk because we don't have enough opportunities out there. But lately, last couple of years, so many new companies getting listed, and then another next 5-7 years, I think there'll be way more liquidity, more opportunities where the fund size and the product category, there will be a lot more justification even at a larger size of the year.
Just to add to that, there's a cycle in which everyone goes through. There are some cycles where you end up performing, or some cycles you end up performing, linked to the styles, linked to the what Sandeep mentioned about risk versus return. How do you take care? This is a function of various cycles in which you deal with. But the size is actually the function of what hard work you do to build the size. I think over is spending more time in terms of penetrating and do service to the larger portion of the market. They of course build a size. And some people may choose not to actually go that way and have only presence in few markets, and the scale doesn't come. Then over a period of time, the scale also comes. Scale, of course, gives the benefit of operating efficiency. If you are small, you can, of course, the lean and mean and focus only on performance. That give you a different kind of model. Yeah. This is one last question that boy was, yeah. Are you a student of NISM? Okay. Yeah, we are audible. We can hear you. You ask the question. We can hear you. Correct.
Recently, if I'm not wrong, SEBI proposed to MP and some largest AMC to add GST and transaction cost in a total expense ratio that directly impact on mutual fund distributor payout. If you want to penetrate mutual fund beyond this 30 city without lucrative payout, what will be the motivating factor? Don't you think that types of decision, it's too early? That types of decision taken after some time when this industry is well penetrated?
Sure. Now, of course, I think one must give due credit to regulatory framework. The B15 was the nature of developing the market. I think B15, to go and see any marketing literature, you will not find the word called B15. You will not find the word called B30. Even lever supposed to be the most marketing oriented organizations, you will not find. They will say rural India and so on and so forth. I think SEBI is the only one who used that word B30, B15 because it comes from top 15, then below 15 cities are top B15 cities. The incentivized for almost for 3 years. When it was introduced in the year 2012, the contribution coming from B15 markets was only about 6%. Contribution coming from B15 market only 6%. The one the regulator pushed the mutual fund industry, guys, go and expand your business beyond top 15 cities. Then people started expanding. And then distribution committee started coming in. were incentivized. Suddenly we saw that 7% number becoming 12%. That means a good growth. Therefore, you change the definition from B15 to B30. Today, B30 contributions is almost about 26% in the case of equity. 26% in the case of equity. In the case of, it has grown quite well and continues to grow. If you take the customer folio, we have 13.5 crores folio numbers. This strategy, not many people may have this. 50% of customer folios come from B30 market. 50% come from top 30 market. That means customer expansion happen in the B30 market. Regulator always will think, that's the job of the regulator. Regulator always think, okay, scale ho gaya, abhi kya hai? I mean, cost has to come down. So therefore the benefit comes. Then somebody mentioned, he asked an earlier question about beating the benchmark and so on. Everybody talked about alpha. Suppose alpha doesn't come, but you're taking care of the beta, but alpha doesn't come. But not taking care of the beta, again alpha doesn't come. Then question comes is, which one become an alternate bet product? That's where the passive comes in. In the change environment, the thought process may be in the right direction. As you rightly say, should we allow the industry to grow to 70 lakh crore size and bring in these regulations? That's the ideal thing to happen. So that allow the industry to grow, then you bring in these regulatory changes, would have an ideal thing to do. But of course, these are some of the things, moving parts will always part and parcel of the discussions and evolving situation taking into account the risk involved and where the industry is growing, mis-selling and so on and so forth. So this is an evolving process. There will always be both the side argument for this. So ultimately, as I always say, truth prevails. As long as the market continues to grow, these changes will only push people to actually innovate and bring new way of doing, as Harsh mentioned about technology can play a role. And Grow sitting in Bangalore, I'm sure he will see the number, his largest buyer can come from North. And somebody is sitting in Chennai, Funds India is sitting in Chennai. Yeah, he always says his largest application comes from Rajasthan, sitting in Chennai. So therefore technology actually removes the completely differentiate between B30 and B15. Therefore, all these things will evolve. So with this, I think it will come to a conclusion. Very interesting sessions. And I'm not going to summarize the discussion given the fact the lot have been spoken. Clearly, the key is industry is poised to grow to 1 lakh crore, $1 trillion size, which essentially means as a percentage of the banking industry will only keep growing. I think innovation is going to be the way forward. Product innovation, solution, and passive is growing. At the same time, as Stephen mentioned about advisors could also become a larger as we move forward, given the fact that community could also grow. And net, I think industry is only on the high growth path. With that, let me thank each of the panel members for your deep involvement and contribution and adding more color to these other discussions.
He has something.
Yeah, Stephen, you want to say something?
No, I was just saying goodbye, and
Okay.
thank you very much for having me.
Yeah, thank you.
Thank you, sir. I think audience wants this session to continue till 3 to 4 hours. So we see lots of messages are coming. Don't stop this session. So thank you. It was an interesting session. On behalf of SEBI and NISM, I thank all the panel members and interesting moderators, sir. So Stephen, you can log out now.
Thank you, Stephen.
Okay. So as a token of appreciation, I request Mr. Pravas Rath, CGM SEBI, to hand over the memento to Balasubramanian, sir. I request Professor Rachana Ved, Dean NISM, to hand over the memento to Sandeep Tandon, sir. So I request Deep Manisha, CGM SEBI NISM, to hand over the token of appreciation to Harsh Jain. So with this, we are closing this panel discussion 3.